Welcome back, everyone. If you're here last month, welcome home. If this is your first time, you picked a great one to start with. Today, we're going to be talking about inside a real deal, the behind the scenes look at a multifamily investment opportunity. It's going to be short and sweet, maybe 30 to 45 minutes. I'll keep an eye on the time so that you can go enjoy the rest of your weekend. But the goal is for it to be packed with valuable information. So let's get into it. As always, feel free to ask any questions and I'll get to them at the end. So just use the chat. So again, I'm glad you're here. I want to start with a question, and it's not a rhetorical one, but I genuinely want you to think about this, right? If I told you right now, as you are sitting listening to this webinar, whether it's online or you're watching the replay, money could be working for you, not because you did something today, but because of a decision that you made months ago. What would that feel like if I told you that could be happening? And that's not a dream, right? That is exactly what passive income actually is. And today I want to show you exactly how it works, but not with hypotheticals, right? But with like a real deal that Phoenix Capital closed in February of this year. I'm going to take you behind the scenes. You're going to see what we saw, feel what we felt during the 48 hours of due diligence, and truly understand exactly how a deal gets done and what it means for the investor who's sitting on the other side of it. So let us jump into it. And for those of you who are new here, again, welcome. But this is just a quick background on who I am. I'm Dr. Nkem Izamama. I'm a physician, a real estate investor. And that is something that I found because, like so many of you, I realized that a paycheck, even a really, really, really good one, wasn't going to build the kind of future that I wanted. And so I started off as a passive investor myself, right? I was on your side of the table. And so I understand what it felt like to invest, but not know, who to trust. I didn't really know how a deal worked or what I was actually getting into. And that experience is exactly why we run an education first kind of mindset here at Phoenix Capital. You should never invest on blind faith, right? You should know what you're getting into. You should understand it, be able to ask questions and everything around it. So today I'm going to walk you through everything, how we find the deal, how we verify it, what the numbers actually look like, and what happens after we close. I want to paint a picture, and I think a lot of you will know really well, right? You work hard. You work really hard. You've built an awesome career. Maybe you're a doctor. Maybe you're an engineer, maybe you're a business owner, maybe you are a busy professional and you make good money. And yet you feel like if you stopped working, right? If you stop working today or tomorrow, everything else would stop as well, right? The income, the lifestyle, the future that you're planning for your family and generations to come. That is a very normal feeling. But it's not from a position of financial freedom, right? That is still trading time for money. And there's only so much time any of us has, right? And so passive income is kind of the answer to that problem. It's not about being lazy. It's about being smart. It's about making sure that the hours that you pour into building your career are also building something that works even when you don't. And that's the most important thing that I want you to understand. And there are a lot of ways to invest passively. So why does Phoenix focus on multifamily apartment investing specifically? And that's the truth, is because people will always need a place to live. Like, that's not luxury. It's not a trend. It's truly just a fundamental human need. And that's what makes, sorry about that. I put my phone on silent. But that's exactly what makes real estate investing something that is resilient, right? That's what makes these apartment communities one of the most resilient asset classes that exist. And truly, unlike the stock market, right? Where you put your money in, in the stock market, right? You put your money in and you can watch the numbers go up and down on a screen with very little transparency because you don't know what's going on. But in apartment, multifamily investing, you can see exactly what you own. You can inspect it. You can understand exactly how it generates income. And with the right operating team, right, you can actively improve it over time. That's what makes this very special. There's a level of control that you don't get in a lot of investing. And so that's why a lot of busy professionals, a lot of high income earners look at real estate investing and specifically apartment investing. Okay, so here's the one thing that a lot of people don't realize when I say passive investing, right? I truly mean passive. And so as an investor in Phoenix, right, your job is not to find tenants, it's not to handle maintenance, all the maintenance calls, it's not to manage the renovations, right? That is our job as the active investor. That's our job. That's what our team does. They handle every piece of that. What is your role as a passive investor? And a lot of people are learning that, right? Your role is to bring your capital, review the investment opportunity, and then you make a decision to invest, right? When you do that, then you start collecting quarterly distributions. It could be monthly sometimes, while we handle everything else. So you get the benefits of real estate ownership without truly the headaches of being a landlord. That is what passive investing truly looks like. And today I want to show you exactly how that happens on our end to make that possible. Before I talk about that, right, I want to talk about the part that I know a lot of people have been waiting for, which is the numbers, right? Before I give you a look at the Park at Arlington specifics, that deal we closed in February, I want to make sure that everyone understands the 4 ways that a passive investor makes money in a deal, because most of us really just think of one of them, which is cash flow. That's the first one. And that's where you get quarterly distribution. So after every single expense is paid, right? The mortgage, the property management, maintenance, insurance, taxes, all of that. After all of that gets paid, what's left over gets distributed to the investors. And that's your ongoing passive income. So that could come monthly, could come quarterly. But then number 2 is appreciation. So as we improve the quality of the property, right? When we do renovations, we do something called value add. We add value to the property. The rents are going to start rising. And when the rents start rising, right, the value of the asset is increasing. And so when we sell at the end of the hold period, however that period is, it could be 3, 5, 7 years, right? Investors are going to participate in that appreciation profit. Number 3 is the loan pay down. So every month, the tenant pays rent, and a portion of that goes to pay the mortgage payment, and you're paying down the loan, right? That means you're building equity over time. And that equity, again, in addition to appreciation, is returned to investors at sale. And the 4th one, which is what gets a lot of investors really excited, and it's what surprises a lot of people, is the tax benefits. So through a strategy, and we talk about this a lot at Phoenix because it's truly a great strategy. It's through a strategy called cost segregation. We can accelerate the depreciation of the property, of components in the property. So as the property is appreciating over time by all the renovations and the value that we're adding, it's depreciating. The actual components of the property are depreciating over time. And so what does that mean in plain English is that you may be able to offset your other income with paper losses from your investment. So that's real money that is saved on your taxes. When all 4 of them work together, right, that's where the total returns, that's where that picture becomes really powerful. And that's why we really love this. So before we set foot on a property, right, before we run a single number on a deal, like, we actually evaluate the market, because a great property in the wrong city will still be a terrible investment. And so at Phoenix, right, we focus on the southeast of the United States of America. So Georgia, North Carolina, South Carolina, Tennessee, and now really expanding into Texas. And within those markets, right, we're specifically looking for 4 things. The first one is population growth. We have to ask ourselves, are people moving into the city, right? The Southeast has been one of the top migration destinations in the country, actually for like the past decade. So it is in our favor. So we're looking at population growth. Next thing we're looking at is job growth. Where are jobs moving to? Where are companies investing in? Because where jobs go, people are going to follow, and people need a place to live. It's that simple. Number 3, we look at, is it business and landlord friendly environment? That is very important, because we need to be able to operate efficiently and protect investor capital. And that is really big. And so that's one of the things we look at very closely as we pick the Southeast to acquire property in. And then the 4th we look at is supply and demand imbalance. So is there more demand for housing than there is supply? So is there more demand than actually things popping up from the ground? Because that is what is going to drive rents to grow over time. So when all of those 4 line up, when they line up, right, we pay attention. And that's exactly what happened in Covington, Georgia, where we bought the Park at Arlington. And so now we're going to talk about this most recent acquisition of ours, the Park at Arlington. First, let's talk about Covington, which is where Park at Arlington sits. When we started looking, right, we saw a city that kind of checked all the boxes. But what really caught our attention were 2 major projects that were already underway. And so the first is Rivian. right? A lot of you guys will know Rivian as the electric vehicle company that is backed by Ford. And they're building a massive EV manufacturing plant just outside of Covington. It's actually going to be one of the largest in the Southeast. We are talking about multi-billion with a B, multi-billion dollar facility that is going to be bringing in thousands of jobs to the region. So that was one thing. That was a huge economic driver. So one of the things I talked about was job growth, right? That's clear. The second is Facebook, now Meta. They already have a data center that's operating in Newton County, which is the same county as Covington. So that's another enormous employer planting roots in the community. And so that increases job growth. And where jobs are growing, people are moving there. So when we have these economic drivers that are coming into the market, right, it's inevitable that housing demands are going to start spiking. So people are going to relocate for those jobs. And then when housing demand spikes in an area that doesn't have an oversupply, we talked about that, right? Rents are going to start rising. And that's exactly the environment where we as apartment investors, that's where we start making the real money. So that's what gets us excited. So we identified Covington as a strong market. And then Park at Arlington came, right? 188 units. It was great occupancy, really strong growth tailwinds. But at Phoenix, truly, we don't just invest at first glance, right? It looks really pretty, but we invested only after we verified all the data. And that is what takes me to the most important part that we're going to talk about today. I want to pull back the curtain and show you something that maybe a lot of sponsors don't talk about publicly. And that's what happens during due diligence, right? That's something that we always say. We're like, we want to do our due diligence, on everything, but what does that really mean? And a lot of us will hear the word due diligence and we just assume that like you looked at some spreadsheets and you reviewed some reports, but that might be true in some cases, but that is absolutely not what we do at Phoenix. So for the Park at Arlington, right, our team flew out to Georgia and we spent 2 full days on ground. That was 2 full 48 hours where we looked at every single thing during those 48 hours, right? Is what separates a confident investor from one that is hopeful. And so I want to walk you through exactly what we did in those 48 hours. We walked every single one of the 188 units. So we didn't just look at a sample. We didn't look at a random selection. We did every single unit. So that means like if the units were vacant, we walked it. If they were occupied with residents, right, we took permission. We let them know that we were coming and we looked at every unit. Even the ones that were offline, right? There's some units that are called down units. We walked it through because we wanted to see why those units were pulled off for repairs, and we wanted to understand why they were offline and what it would take to bring them back online, right? So we looked at every single unit, but we didn't walk them by ourselves, right? I didn't walk them by myself, but we brought experienced contractors with us. We brought professionals who could look at the HVAC unit and tell us immediately, does this have 3 years left? Does this have 5 years left? Is this going to be bad tomorrow, right? We looked at that. We brought those people, and even people who could spot like how a slow drip under a sink that maybe others might have ignored, right? We brought the people who would look at that and tell us. We assessed flooring. We looked at windows specifically because we wanted to make sure, we wanted to see how long the windows would last. We looked at appliance age. We looked at roofing conditions, everything. We looked through it. We also walked the grounds with our property management team. So we looked at parking lot, landscaping, exterior lighting, because how a property looks and feels when you drive in, it really kind of reflects and affects your ability as a potential new resident to lease. And then thinking for us about what do we need to do to raise rents, right? Especially on the exterior. And truly, what did we find? We found a property that was in solid condition and a lot better than what we thought we would see. The seller was truly a responsible seller, and that I think was a green flag. So everything we saw on paper when we did due diligence, right, we went in and we said, okay, this truly is a great asset. So that was the physical due diligence that we did. We also did financial due diligence. And it's just as rigorous as the physical side, right? So at the same time we were doing the physical inspection, another part of the team was truly buried in the financials. So we pulled the T12, and the T12 is just a trailing 12 months of profit and loss statements of the property. We looked at the rent roll. So every single tenant, right? We went line by line record of every single tenant, every single unit, and every rent, every lease update, we looked at that. Every when the date, the lease date started, when it was ending, are they up to date? And we did something like very critical, right? We compared those rent rolls to the actual lease files one by one, right? Because we wanted to confirm that the tenant that was listed on the rent roll is actually the one that signed the leases and that the numbers matched. And all of this is important, right? This is $1 million property that we're buying with investor capital. So we do not take this lightly. We don't take it for granted. But I've seen deals that they don't, and this truly is how investors get hurt. So you should be empowered to ask these questions. Another thing we looked at is delinquency, right? So who's behind on their rent, how far behind, were there patterns? We reviewed payment history, were there people that we were going to start working to evict, right? We went through operating expenses line by line to make sure like there were no hidden costs, no red flags. Were there any contracts that we needed to take over? Were there any contracts we needed to end? All of those, we looked at it in the financials. And truly the result is the financials checked out. Occupancy was real, the income was accurate, right? And we had, after that, we really had full confidence that what was being presented to us was the whole truth. And that even made it more exciting, that we wanted to buy it. But this is the part that made us really, really excited. Because so during our review of the financing, right, one thing that we really loved was that the property came with an assumable loan of 3.5%. So I want to put that into context for you, right? When you borrow money to buy a commercial building today in 2026, you're typically looking at interest rates somewhere between like 6 and 7% today. And so getting something for 3.5%, we were able to assume it. And what it means to assume is just to take it over, like to take over the existing loan that was on the property. It was fixed rate, so it wasn't floating, wasn't changing, wasn't variable every day. That fixed rate cannot change while we have ownership of that property. What does it mean to you as an investor, right? It means that our debt service, right, our monthly mortgage payment is going to be significantly lower than it would have been if we went with like market rate, right? If we went with getting new debt today. And so that lower debt service means more of the income that's coming from the property, right? It's going to flow into the cash flow distributions, which you as an investor participating. So it just truly means that there's like a wider safety, a wider margin of safety, which is important. So it also means that the deal works, right? Let's say we projected the rents to grow 3% every year. If it ends up being slower, let's say it's 2.5%, right? Or 2%, right? That margin of safety helps us out because the deal even works at a slower rent growth, right? So in real estate, the financing is very important. It's almost just as important as the property itself. And so finding 3.5% fixed debt in today's market is like a golden ticket. So that just, again, right, these are some of the things that you should know when you're thinking about investing. And that's the moment where like the deal truly made sense. So the appreciation piece doesn't happen by accident, right? This is the kind of thinking about renovations and value add strategy. It happens because like of that deliberate strategy that I talked about, which is called value add, right? So at Park at Arlington, I want to kind of explain what we're planning on executing. We're not going in with like a rushed disruptive renovation. We're not doing that. We're not going to displace residents. We're not going in and just gutting. We're not doing it. We're not flipping overnight. That's not our style. Frankly, it's not the best investment strategy either, right? We do renovations at the right time when the market calls for it. So instead, right, the strategy is more as the leases naturally expire, like when a resident moves out or comes up for renewal, right? We are going to start upgrading those units. So, and when we think about value add and upgrading the interior, right, we're thinking modern finishes, updated appliances. So some of the appliances don't have washer dryer. That'll be our time to add that because that's part of our business plan. Improving the aesthetics. And then like with those upgraded units, right? And when we start renovating it, we can command higher market rents, right? So when we take a property that's classic, like 2001, right? And we renovate it to 2026, that newer property, that newer unit, right? It can command higher rent. And this is what's important. The prior owner, right? They already proved that the strategy works. So they had already started renovating and they renovated some units and they got higher rent premiums for those upgraded apartments. So that gave us kind of like a blueprint of how to follow, how to go, what to do. So we're not really guessing, we're just executing. And then over time, right, as the rent start to grow across the portfolio, right, the net operating income also starts increasing. And net operating income is just simply like the income minus the expenses, right? So what comes in minus what goes out. So as we do renovations, and the rent, which is on the income side, as that goes up, right, the net operating income continues to go up, because our goal is to increase income and decrease expenses. And this is one of the most important takeaways in multifamily real estate investing, right? Is that the property value is directly tied to the income. So when you start having higher incomes that are coming in, right, you're going to then, that is going to equal higher value. And so that is how appreciation is created over time. And that appreciation is going to come back to you as profit at the time of sale. So it's not luck, right? It's truly strategy and what we're thinking about. So the numbers that you see on the screen is kind of the four pillars that you look at. And I talked about that a little bit, but now I want to break it down for Park at Arlington. We are projecting around 6 to 10% annual cash flow, and that's going to be distributed quarterly. So if you invested 100,000, that looks anywhere from 6 to 10,000 just from cash distribution, while you still own a share of the asset, right? That's money that's coming into your account and that continues to grow in value. And then the total annualized return. So when you factor in the cash flow plus the appreciation we talked about from value add, plus the strategy of, of paying down the loan, we are projecting around 15 to 17% annualized returns over the 5-year hold. So on an annual basis, right? When we include cash flow and then appreciation from value add at the end, all of that looks like you'll be making around 15 to 17%. But then let's talk about taxes, right? So I told you through something called cost segregation. You can now receive around 45,000 in tax deductions for every $100,000 you invested. Your specific tax situation is going to be different, so please definitely talk to your accountant. But what I want you to understand is the potential, like the magnitude, the benefit of what it means to invest in this, right? For a lot of high income professionals in the top tax brackets, this alone can be very transformative. And so that's something that you want to pay attention to. So we talked about how we found the deal, how we verified it, what the numbers look like. And now I really want us to talk about what happened after we closed. So we closed in February, right? And so that means that we've had months. So what's that? 4 months of real operations, not just projections, but actuals. So occupancy, with new takeovers, sometimes occupancy goes down. So occupancy is currently at 90%, but we're working with our property management team to bring that back up to 95%. The first distributions, right? We usually start distributing after a first quarter, after full financial. So that's going to be end of June. So investors are getting ready to get their first distribution. And then renovations are underway. So we focus, remember I told you we're strategic about renovations. So we focus on exterior renovations first, and then we're going to start moving inside. And then since we close, our investors are getting monthly updates and quarterly investor calls, just to really understand how the property is performing, what the financials look like. They get that every month, but every quarter we kind of collate that together and kind of talk about it. We also talk about capital expenditure, what truly is happening in the property month to month. And I want you to see what this looks like in practice, right? Because a slide deck and a projection model only gets you so far. But the real measure of any deal is what happens really when the rubber meets the road. And so you're getting truly a glimpse of what it's doing today. And so you can see kind of the income coming in, the expenses going out, what that looks like. And it's important because our investors get transparency throughout the entire process. Again, I told you monthly updates, quarterly calls, clear communication, and they have access to this information. That is the Phoenix standard. And that's what you want when you're investing with an operator. So every deal teaches us something. And this is what Park at Arlington truly reinforced for us, right? The market truly matters, right? The Rivian effect, the metadata center, right? They're not hypothetical anymore. These are truly real economic forces that are driving demand for housing in that community. And so when you pick the right market, right, the market starts to work for you. This is very important. And I also wanted to re-emphasize like the importance of financing, right? When that 3.5 assumption loan that we got, right, it has saved us hundreds of thousands of dollars in debt service as opposed to buying at markets. And so in a tighter rate environment, right, deals like this become the difference between good returns, a cash flowing property, and then really exceptional ones. So you just have to be thinking about that, right? My goal today is to kind of take you behind the scenes to see what happens, how we think, how we make decisions. And then the third one is that, due diligence truly matters. The confidence we have to move forward and the confidence that even investors have to commit with us happens after we verified on ground what we assumed on paper. We verified it on ground and even in the documents as well. So it's not from what we were told or what the brokers said, because everybody wants to say the best, but it's from what we confirmed, which I think is very important. So as I wrap up, I told you be short and sweet and jam-packed with value. And so before I open it up with questions, I want to leave you with three things, right? And I think when you understanding every deal is important, but from a high level perspective, right? Number one, passive income is very, very real through real estate investing. It's not a fantasy. It's not something that it's only for people who are born into wealth, right? The Park at Arlington shows exactly what that looks like when everyday busy professionals decide to let their money work alongside with them. So when they're working their 9 to 5, right, they're using that as leverage to start investing in real estate and to start building passive income. So that's the first one that I want you to truly understand why this is important. The second one is truly due diligence, right, is your protection. When you invest with Phoenix, right, you're not betting on a pitch deck, and we make some beautiful pitch decks, right? But you're investing behind a team, right, who has said, you know what, we're going to go on ground and look at this property and make sure that what we assumed, right, we bring it to life, and we bring it to life with a whole team. So that's, again, checking every lease file, stress testing every assumption. So what happens if occupancy drops to this certain percentage? What happens if rent doesn't grow? All of that we're stress testing through due diligence before a single dollar is committed. And that's very important. And that is one of the ways that we protect your capital. And whoever you invest with, right, this is the standard you should hold them to. These are the questions you should be asking. This is the expectation that these are the things that I'm going to get. And number three, right, you don't have to understand every detail to invest wisely, right? That's what, you have a team for. That's what the operating team is for. But your job, I think, I believe, is to understand enough to feel confident in your decision. And that's exactly why we have sessions like this, right? Once a month, we really pour into our community to really understand investing, to understand real estate, to really just give you what it feels like to be financially literate, right? That's very important. So you can invest with clarity and not just faith, or not just because you like something, but you can see the work that goes behind it. So if you heard something today that resonated, if you're thinking about whether a deal like this, right, could have a place in your financial future, then I want to make it easy to explore that, right? The first thing I always tell every investor, even our current investors, right, was to book a call with our team. And we'll toss the link in the chat, but it's also on the screen, right? It's really just a conversation, a chance to ask specific questions, to share where you are, to understand if this kind of investing makes sense for you, for your family, for what you're building long term. And what we do, we spend a lot of time creating educational resources for you to learn, for you to feel empowered, to feel equipped so that you can make the right decision, right? We're constantly looking for the next best deal to bring to our investors. And so while we don't have an active deal right now, right, go on the website, go take a look at the educational resources and go deeper on everything that we've covered tonight. We have multiple resources there that you have access to. And again, right, if you're not ready to invest, that's completely fine. What I want you to do is just stay here, stay in the community, keep coming to these sessions, keep learning, watch the replay, wherever we're streaming it on, just enjoy it, take part in it, right? And then keep learning. The best investment you can make right now is in your own education. And that was one of the first things I did. And that's how I'm able to have these conversations and share. It's from what I know, but the first thing I did was to pour into learning. And I think if you do that, right, you'll be, every step of the way will be easier for you. You'll be able to make decisions with a little bit more confidence, which is very important. So I want to say thank you for spending this short and sweet half hour of just like really value packed of what it looks like to look inside a deal. Time is the one thing that we can never get back. And so I don't take it for granted when you decide to spend time in these sessions. I've opened up this window, right, in how you can think about wealth creation, how you can think about investing, and what's possible with the right team, the right strategy working for you. So again, like the link is in the chat, book a call, have a conversation with us, understand again our thought process behind why we do what we do. But more than that, right, understand or ask questions on how this will align with your investment plan, your financial growth in the future. So again, thank you so much for your time. And I hope to see you next month at one of our community investor webinar series. So time for questions. If you have any questions, please drop it in the chat. But more than that, enjoy the rest of your Saturday. And again, I hope to see you next month. Sweet. Oh, you're very welcome. And like toss, if you have questions, toss it in the chat and then we can go through them. I think someone's typing. Okay, good question. How long does it take to typically exit a deal? It just depends. We try to stay in a deal for about 5 years, and that is enough time to really execute the business plan. And then we plan to sell it. But the whole period is about 3 to 5 years. Another question. Okay, the questions are coming up. People are awake. How many LP deals did you do before you became a general partner? I did. I was in 3. And that's, so what she means is, how many deals did I partake in as a passive investor before I went on the active side? And for me, it was important to fully understand it. And I used that opportunity to really understand how a deal works, to understand the ins and outs of it before I decided to do more. Great question. I think someone else is typing, so I'll wait for the last question or as many more that are coming. You're welcome. Wonderful. Okay, no more questions, everyone. Have a wonderful rest of your Saturday, and I'm looking forward to connecting with you. I like how we can see everyone's typing. Okay, wonderful. Bye, everyone. Good. Have a great rest of your Saturday.